ASML just released Q1 2025 earnings, and after this, the stock fell by roughly 6%. Now it's back up a little, minus 5%. So yeah, we'll discuss about this in this video, about the earnings, all the things that you need to know about this report, those earnings. The year-over-year performance is minus 12%. Okay, so it's a year-to-date, not year-over-year. It's a year-to-date performance is minus 12%. So yes, there is some bad news during those earnings, but they are not that bad. Okay, they are not extremely good, but not that bad. So you will understand why the stock declined in this video, and you will as well understand if the thesis on ASML may still be good, and if it can still be a nice investment. We'll take a look at the valuation. So here's some word from the CEO. Our conversation so far with customers support our expectation that 2025 and 2026 will be growth years. However, the recent tariffs announcements have increased uncertainty in the macro environment, and the situation will remain dynamic for a while. So this is a bit, I'm not saying a strange declaration, in a sense that he's saying that there should be a growth, but because of tariff, maybe you will not have growth. So it's a bit strange to understand it, but yet by the environment point of view, when he talks to customers, he thinks they will have growth. So talking about growth, the net bookings, okay, is up 9% compared to Q1 2024, but is down 44.5% compared to Q4 2024, okay? The problem here, and I think it's the main problem with this company and with this earning, okay, the release, is they had 3.9 billion net booking, and analysts were expecting something around 4.8 billion. So it's way under what analysts were expecting. And I think that's the reason why the share decline like this is because it's way under what analysts were expecting. When it comes to net sales, it's up 46% compared to the full last year, and down 16% compared to last quarter. Okay, the system sales up 44% and down 19%, and the service sales are up 51% and down 6.8%. You can see that they are way less down, so it's good that they have a good service area, and it's what maintained a bit the company and the earnings and the income from the company, because service is way more profitable, way bigger margins, and that's why it's done. That's why here from the margin, you had a gross margin of 54%. You may think, oh, it's a great news that we have 54% when the guidance were between 51 and 53%. It's not that a good news, because it's mainly due of the fact that a lot of revenue came from services and not from the sales of system. The sales of system went down 19%, while the services only 7% compared to last quarter. So this is where it can be a bit not problematic, because it's always nice to have this revenue. It shows some good strength in it, but that's why it's 54%. So don't be fooled by this 54%, because if they manage to increase back the system sales, you will have something probably around between 50 and 53. Okay, so operating margin are 35%. They were at 26% first quarter last year. So it's pretty good. If we look a bit at the numbers, at the history of the number of the company, when you look, for example, at revenue and you look at it on a quarterly base, okay, you can see that Q1 of each year is not generally the best one, okay? Q1 2024, it was a big decrease compared to Q4 2023. Q1 2023, it was better than Q4 the year before, but Q1 2022, same. So it's something that we see a lot with this company, that the Q1 is less good. We had this one good in 2023, but 2023 was after 2022, and it was a year where growth started coming back for the tech company and so on. So I will not really take it into consideration, but just remember that it's kind of normal that this Q1 is less good than the other quarter, okay? So don't saying it's out just because we have this decline in Q1 that it's representative. No, it's not representative, and you need to compare Q1 now and Q1 before, and you can see that Q1 now from the Q1 last year, we have some growth. We have some growth, it's still growing, but it's only growing 9%, okay? This is what people don't really like, I guess. It's because it's not growing as much as they want. When it comes to capital allocation, the Capex should be around 1.2 billion, okay, it's declaration from the CEO, from the earning, and they did 2.7 billion buyback. It's very good, considering that the share price may be undervalued, okay? The share price may be at a very good value now, so doing massive buybacks here shows that, yeah, they are confident that the company is undervalued. The dividend only increased by 4.9%, which is an increase, but it's kind of a low increase for companies that grew by 40% the net sales. Okay, it's a low increase. It's like it's good that it's a low increase. I like it because it seems that they use this money to do buybacks. Instead of growing more the dividend and paying more dividend, they did buybacks, which is, in my opinion, better because dividend you pay tax when you receive it. Buybacks, you don't really have tax on it. So it's, in my opinion, it's a smart move, especially with the share price that they have now. Obviously, when the share price is way higher, we don't really expect them to do a lot of buybacks. They will do the buybacks that they do usually, but they are more aggressive in the buybacks now. So I think it's something pretty good. When it comes to guidance and conclusion before going to look at the valuation, the guidance for Q2 2025, they expect the net sale to be between 7.2 and 7.7 billion. Okay, so if we compare with last quarter last year for Q2, so Q2 was last year is this, so it's growth compared, like it's a good growth rate compared to the one they had last year. So this is good, okay? And a gross margin between 50 and 53%, which is more normal because apparently I think they will have more system sales than service. So this is why the margin will decline a little. For the full year, they expect to have net sale between 30 billion and 35 billion. On one hand, we can find it good. We can say, okay, if it's 32.5 billion, which is in the range, it will be a 15% growth rate. The thing is, if it's 30 billion, it will be a growth rate of only 6%. The growth rate should be between 6% compared to 2024 or 24%. That's a lot of uncertainty here. It's not like we're talking about, oh, will we have 15% or 20%? No, we're more talking, we'll have 6% or 24%. And I think the market don't really like this information. The market don't really like this because it can be a bit of a wide range, okay? The gross margin should be between 51 and 53%, which is kind of normal. So from what the CEO said, like the uncertainty seems to be quite big for the growth in 2025, in a sense that we may have good growth, but with the tariffs that they have, with all the tariffs, the macroeconomics, they may have some trouble here. The CEO said it will be a growth year, but in the guidance, having 6% growth is not what investors expect. The investor accepted to pay a premium on this share because of their high growth profile. So the question here is, are we arriving at the top of the cycle profit? You know, the cycle profit is you have a company growing. Everybody, the analysts, Wall Street, so on, think that the earning will continue to grow fast. So they invest in the companies, they accept to pay a premium to invest because the revenue are supposed to grow fast. And then the revenue, finally, we just realize that we expected maybe that it will grow way faster than what it was supposed to be. So at this point, you have a company that you probably overpaid and you realize that you may not have a decline in the revenue, but you have a growth which is way lower than expected. So the premium that you pay is not justified by the growth that the company will have. And then you have a stock which is not performing that well. I'm not saying we are in this kind of cycle here, but maybe if we have a 6% growth for 2025, on the short term, maybe we're at the top of the cycle and we'll need to have a year or two with a low growth, okay, less growth than expected and maybe less than 2-digit growth. But on the long run, I still think that the company will have a high growth. Like they have a huge monopoly, they have great moat and so on. So I think on the long run, it should be good. But maybe for 2025 and 2026, we can expect less growth. Maybe it's something that will happen, so we need to take care of this. Especially with the company, you pay, remember, you pay a PE of 30 for this company. Okay, the actual PE is, the actual PE is around 30. So it's not the lowest, okay? It's way far away from the highest PE we had. Okay, the median here is 36, but yet it's still a premium. It's certainly a good company, so I understand paying a premium, but 30 is start to be an interesting premium here, okay? When you compare to the other machineries company in the semiconductors, you pay less of a premium. You pay them more around 20 as a PE. Here you paid 30. So 30 should be justified by very high growth here. And we may not have it for this company, at least in 2025 and maybe 2026. When we go to valuation, so we take the earnings that are expected to be for the net income expected to be for 2025. The stock price is actually 577 euro. Let's say we'll have a PE of 25 in the future. So we can say the median was 35, but I would be honest, like I don't think that we'll have a 35 PE in 5 years. Maybe we'll have, but I prefer to be very conservative with my valuation model. So I will put 25 here. We have number of shares outstanding 393 million. It should be less. I didn't include the last buybacks here, but on average for the last 10 years, they did 1% buybacks. So we'll keep this 1% buybacks for the next 5 years. Again, I prefer to be very conservative with this. If you think the company will grow its net income by 15% per year for the next 5 years, you will do 16-17%. The fair value is around $677. So at $677 fair value, now it's a good price to buy. Now, if you think the income will grow by 10%, the fair value to do 13% per year would be at 542 euro. This is if you think the company will do 10%. If the company grow by 6%, the earnings that the revenues that they may have next year, okay, the growth, the fair value is 450. I think net income will not grow like this because they improve their margin and so on, so it will grow a bit faster. But it's something we need to take in consideration, that maybe we'll have slower growth than it's expected. So I think expecting 12% growth for the net income for this company per year for the next 5 years is pretty conservative and it's pretty accurate. So with this, we should do 13% per year, 13.6% per year with this price at 577 euro. The fair value is around 600 euro. So I think buying ASML, if you believe in this company and you think the moat is very strong and if you believe in the future of this company, I think under $600 euro, it's an interesting price. Now, depending on the growth that you will have, you may have less, more, you to do, but 12% is a good price. 15% is even better. So to justify the price now, you will need something around 11% growth for the net income. And I think it's very achievable for the next 5 years for this company.